structure, and now we're even evolving, and that's why I'm first going to pick up on things just said before. We had a fund, Chess Capital. It was a zero management fee fund, Buffett-style partnerships. In small, my experience is mostly in small caps in Europe. So I don't have to tell you, the last 5 years wasn't great. It was a terrible market to be in. Our results were close to the index, to the benchmark, but that was just lousy. We just had inflation. We also built a quite good network going to ValueX from Guys Peer, other conferences, and there we met other fund managers, people around the world, in Africa, in Asia, specialized in Turkey, specialized in commodities, all different kinds, and they have excellent results. So we decided, well, let's break it up. 30% of our portfolio will be still managed by me. The other 50% will be managed by other fund managers, all same style boutique funds, small manager, all his money in that one fund, most of the time even also zero management fee funds. And then we put 20% in an option fund, specialized in those black swan events. And that's why I'm going to pick up on that first, because we went through that process as well. At ValueX, I met Luca Delana. Luca Delana is an Italian, it's a professor, and he has a book written on ergodacity. So I don't think you know him.
Yeah.
If you do know him, if you don't, look him up. He has great speeches. I think it was this year or last year at ValueX Berkshire Hathaway, he talked about it as well, and that's online. You can see it. It's a very great speech. It talks all about the ergodacity and why you need the protection. And he always gives the story about his, I think it's brother-in-law or sister-in-law, I don't know, that was a professional skier. And it's not the fastest skier that ends up winning all the thing. It's the one that's fastest and still gets down the hill. Because most of the time the fastest don't get down the hill. And that's why he always says ergodacity is very important. And we calculated as well for our fund. If our experience was, we started in 2020, it was a good year. We didn't have the COVID boom, we started just after, so that was a shame. 2021 was a good year. And people come to you and throw money at you. They all want to invest in your fund because you're making 15%. Oh, here's money, here's money. We doubled in size, and that was a problem because I didn't have enough investments anymore to put the money to work. Having said that, 2022 was a lousy year because I did have to make investments in a fund, even a non-public fund like ours. You can only have 30% maximum to one counterparty. And cash is also considered one counterparty, so I couldn't hold more than 30% in cash. So we had to invest. So I invested in stocks that I thought they were okay priced and they would survive. But in 2022, everything crashed. So down went our fund as well. And as a zero management fund, that wasn't fun. Because in 2023, it was a decent year, plus 10, but not enough to get above the high water mark. 2024 was a really rotten year for European stocks because everybody went crazy with FANG. We did -3, so around the market average. But that means that this year still we haven't crossed our high water marks. So if you do a zero management fee fund, anyone, be prepared to have at least 3 to 5 years of your expenses aside. It's just a tip. And that's also why we're evolving and made the new structure and put it in the option fund. Because in 2022, a bad year, in November 2022, we called all our investors, people that said we're interested, and said, well, now is the time to invest. Our fund was at that point at an EV/EBIT of 5. It's crazy low. The whole fund, the whole aspect of the fund, 5 EV/EBIT. We had private equity investors in the room that said we can't find any investments that cheap in private equity. We said, well, invest in our fund, it's easy. Nobody did. Only my brother-in-law and me invested extra money in the fund. That's all. And that's why we also went to the option fund, because now we know when the market crashes, we will have a large payout of the fund. Cash we need to invest in the cheap securities at that time. Because at that time, there will be people leaving your fund. So that's a reason. And second, you said it costs money. The one we're invested in is also from Belgians. It's a father and his two sons that started it. The father is a professor in statistics. And Gert laughed when I said it earlier, because most of you will know the story of LTCM, all the mathematicians that still still went down badly. Well, Luc has experience since 1985, has done it for a wealthy Swiss family, then started a fund, sold it to Robeco, and now his quiet period is over, and the sons wanted to start it again. So it's 1.5 years in the making, I think, and I think it's about a year that it's already there. It's called Enigma Legacy Fund, and so far in the statistics of Luc, his career, he has always made around 4 to 5% a year with the fund, with the option fund, and then in the moments you need it, it just boomed. Now the short-term track record isn't fair, because you had COVID, you had 2022, you had April. So they had 3 events when they made a lot of money. That's not normal. You could, normally in 10 years you could expect 1, maybe 2 events maximum. Now they had 3 and 5, so it's not realistic to see their performance fees and their performance now. And it is available to everyone because it's a UCITS fund. It's a Liechtenstein-based fund, UCITS, and it's you can buy it through Saxo. So the private investors can go to Saxo and look at it. And if you're a fund manager and you can invest 2 million to have your hedge, the fees are quite low. It's just a 0.5% management fee. That's all. So not worth doing all the work yourself.
No, exactly.
So just to pick up on what we just heard, it was our experience as well. The other way a value investor can keep himself safe is like Warren Buffett, build up cash. And cash is always a drag on your portfolio. So why not have a fund that makes maybe 2, 3 to 5%? It's better than zero for cash. So that's why we did it. And the payout will be 20. I'm going to mix them up. In 2020, they had a 43% upside in March. So if you sold then, it's 43% a little more than that you can invest. And in 2022, it was up 50%. So in 2022 wasn't even that bad. I myself expect I think between 50 and 80% would be a decent devaluation of the Standard & Poor's at this moment. I think it's just absolutely crazy. I've written blog posts about it. I'm happy to discuss that as well. But my vision coincides with that of Michael Green. I don't know if you know him. He always speaks about the passive investment flow. The passive investments just put all the money. He says it's the simplest algorithm there is. You give me money, I buy. It doesn't care what the valuation is. You just buy. And all the 401ks in America and all the pension funds, they're all starting to put money in those index funds. And that's just a circle that keeps everything going up. That's why we have these crazy valuations. But in America, it's also so. You don't have the social security that we have in Europe. So from when people start losing their jobs over there, people will start withdrawing money from the 401ks.
And retiring, don't forget to retire.
And retiring.
That's a baby boomer.
That's also a big one. So at one point, now we're going up, and at some point, it will go down. And it will go down fast, very fast. So that's why we think the option fund is also a necessity. If you want to survive as a fund manager, you need to make sure that you don't have that big crashes. It's not our intention to be the best fund at any period, but it is our intention to always be in the top quartile. If you're always in the top quartile, then you'll be in the top 10% over a decade, and you'll be in 20, 25 years, you'll be in the top 1% of funds. So that's our idea. But I think Iggy mainly asked me because I have experience in writing as well, Substack, and that there are a lot of people with ambitions here, maybe in fund management or Substack. Maybe I can tell first my background isn't in finance. I got raised in an entrepreneurial family. We had photoshops that evolved to multimedia when I took over. 25 people in staff, about 800,000 euros in stock. Electronica stock depreciates 3% every month, so it wasn't a nice business. And at that time, when I wanted to take over, you still had to have, I had no idea what the English word is, a certificate to be able to be a photographer. Now, you know it here as pharmacies, you can have only one pharmacy for maybe 50,000 people. That was the same with photographers back then. Yeah,
At least
crazy.
in Belgium.
At least in Belgium. So it was rather crazy. So you had to be a photographer yourself, or you had to have employed staff who had at least a certain level of degree that was. So I didn't want to be dependent of our staff. So I'm a photographer. My mother-in-law was studying accountancy. She took me along. I went to courses for CFO management. And there a professor put Colruyt, which was then a fast-growing supermarket chain, against something that was fraudulously went bankrupt. And I thought, if it's that easy, that's something I'm going to do myself. So that's how I got into investing. So no finance background, read hundreds of books, and for the rest got the experience the hard way, like everyone needs to, even if you have a finance background. I started writing in 2005. Inspired by the Magic Formula from Joe Greenblatt. The book came out. I tried to make it Europe-based. We closed the shops 2010. I started a newsletter in 2011, a paid newsletter. Wrote it myself for a few years. Went to one of the biggest publishers in Belgium. Wrote for him for a decade, and now write myself. And at some point in that newsletter, I was really frustrated. I don't know if anyone here is old enough to remember Nierstar, a Belgian company. Also a very fraudulent story. So I was frustrated because I noticed it. I saw it in advance. I wrote about it in the newsletter, but it was one of the market darlings at that time. I said, well, this is going to go bust, or not bust, but it's going to go bad because the wines in Perth are not working out. I wrote about it in the newsletter. I lost about 10 to 15 subscribers. All were mad at me because
Paid
subscribers because they were mad at me and saying, yeah, well, it's not true, and it's Nierstar, and it's going to be great. If you want, look it up. See how it ended. But I was really frustrated about that, and I wrote in the newsletter, well, maybe it's time to take it a step further. I'm exactly 50 years younger than Warren Buffett. It's in the same week, so it's not exactly, but 5 days apart. 50 years younger. I said Warren Buffett at age 38 was already there. I'm looking for someone who wants to start a fund with me. I would like to be your mugger. That's how I worded it, because I don't. Warren Buffett is a political one. I thought Munger was always the more funny one, so I hope to be that. My current partner called me. We met once before at an event. He called me and said, well, let's talk. We talked 3 times, and we started our fund, Chess Capital Fund. Not an arbitrary name. My partner is, he's not a grandmaster, but he was a very good player. And he also had a non-profit wanting to return the first grandmaster in Belgium, youth grandmaster. So they did, so that's the chess part. And my newsletter always compared stocks to chess pieces. So we as investors are the kings, and without us there is no game, and then you have the quality stocks that are the ladies, queens, sorry, and so on to the bonds, which might be biotech companies, or maybe something going to restructuring, mining, all those things.
Oil drilling.
Oil drilling, yeah.
Exactly. So that's where the name Chess Capital came from. So the main things I learned, and maybe that's something I want to give to aspiring investors, or wanting to start a fund or a newsletter. One, start with a newsletter, but don't expect to make any money. The newsletter is great. It opens doors. A few of the people we will be investing in with our fund started with a newsletter gave their analysis to Guy Spear, went to ValueX, met us, and they will have at least 1 million from us. And I know one of the big investors that always attends will be dropping 5 million. So please write, but don't expect to make money of it. If you're an investor and you write a newsletter, do it out of passion. Because if you want to be the newsletter to be profitable, you won't be an investor. You will be a publisher, and 80% of your time will go to marketing. As I said before, compounding quality. I've known him since he was 15 years old. I've been at a few decisive points in his life when he wanted to make the jump. I was there when he called and said, well, should I do it? I said, well, knowing you do it. But his time on investing is from 5 a.m. till 8 a.m. and that's it. The rest of his day is all about marketing. So have the right expectations starting that. Even for me, I have about 250 subscribers left because I don't do any marketing anymore. So it just diminishes. It came from 2,000 a few years ago, so when it was under the publisher, so he did all. But it opens doors, and that's the second thing I learned. I always worked from home, and I didn't build my network, and that was the biggest mistake I ever made. Build a network, and not only of other investors. These things are excellent for this. You get to know other investors, but also, well, people who might invest with you. It's very important. People have to get to know you, have to trust you. So I think that's the main part. The third part is get an account at the Interactive Brokers. Maybe it's stupid, but Interactive Brokers, the performance files they give you, they are of that high quality that every investor will accept it as an audited statement. So get your portfolio there. Don't make a mistake. I did. I had because I was young enough. I had the first online bank key trade, and then I went to the cheaper one, Saxo, Bing at the time, and I moved a lot. And it's hard to keep a track record, and everyone thinks, and some money went out because I had, and we bought a house, and then no. Keep a track record, keep it at Interactive Brokers or Links or Mixum or any one of those that gives those reports. Maybe something very stupid, but it helps. They also have services where you can send your reports and then other investors might invest with you, but no experience with that. Then experience with the fund. Don't think too big. That's the first thing. The only people that will invest with you in the beginning are friends, fools, and family. You won't get any outside money further from that. If you have a good network, my partner had a good network, we were able to gather 20 million. So that was, from everyone I heard, I talked to at those conferences, they all say that is amazing. Most people start with $4 to $5 million, and that's it. So also have those expectations right. And if you have it, you also know how to structure your fund. Don't go overboard like we did. You don't need to have a big structure. I don't know if you're based in Holland. You can have Fonds voor Gemene Vorm. Someone in English.
Fonds voor Gemene Rekening.
Yeah, Fonds voor Gemene Rekening, but in English.
Financially transparent.
Yeah, it's fiscally transparent fund. Yeah.
Fiscally transparent, yeah. Definition.
But you need the Dutch term anyway, so.
Yeah, but every European country has the same concept. In Belgium, it's Maatschap. In Luxembourg, also it's the FVB. So every country has it. You can start off with that. It are your friends, fools, and family, and they trust you. So it doesn't matter if you don't have all the administration and the security. Start small. Expect it to be small a long time. If you can grow, you can always change it up. And then it's easier to find, because the hardest part for us was finding a bank to hold the accounts. Because if the bank needs to hold the account, but they don't make any money of you because you just get a transfer of the investor and then you transfer it to your brokerage account. So they don't make any money, but they have to do all the KYC. So nobody wants to service you if you don't have 50 million. There is one in Holland, I know it does, but you have to contact Circle Partners to know who it is. We went to Luxembourg because there's a whole market there, but they're expensive.
Rabobank opened it up in Holland.
Oh, okay. That's
Yeah, just recently this.
Yeah.
Like,
okay. In Belgium, it's still.
no, that's just recent. Before that, people had to get like IDs from like London and Spanish banks, but now Rabobank.
Yeah, I think it's what Northern Trust was the one
Yeah, they were
mostly used. Yeah.
That's expensive.
Yeah, it was super expensive. Yeah.
Yeah. So have your expectations right. That's the main thing I wanted to talk about, and then I wanted to open it up to questions and answers because I think there will be more questions than me. We can also talk about stocks. I know the Belgian market quite well. I know the European market quite well. I don't know all the stocks, but I have an opinion on all of them. If that helps.
So Ukraine market,
Sorry.
Belgium, and what market?
We do the. I'm specialized in European value.
Oh, European.
Yeah, European. Mostly Nordics, UK, Belgium, Holland. Less France. Difficult country.
What do you feel is the best spot to look for cheap stocks right now within Europe?
In the UK still.
UK?
Yeah, I think the UK is definitely very cheap, but they also have troubles. I don't know what to call it, but yeah, the Nexo story I think is
Corporate governance.
yeah, the IEM market is really getting hard. Anexo is not the only story that's where a company just did what it wanted to do and nobody cares. They just let it all pass. So
Argentex, also some people here who own the Argentex, I think, other AIM stock that blew up.
yeah, I didn't own Anexo, but I did own Argentex. Yeah. So it's a cheap market. You have a lot of great companies there. I just told at the table, the one I have there that I think is the most promising, and that's also small, maybe micro cap, is Focusrite. We're recording this. The analog signal needs to be put into a digital one, and they make the interfaces for it. But if you go look at the big music online stores, the retailers, Thomann music store, Sweetwater, if you see the product category for it, it's always a picture of their product. So it's like the going back to the photo business, photo camera in dialect in Belgium was called a Kodak. What it wasn't, and that's the same with Focusrite. The Scarlett interfaces are just everywhere. They're better than all the rest, and the thing they now do is they buy other companies that have adjacent products. So the studio monitors and then the mixer tables and so on. And why is that needed? First of all, Focusrite is still managed by the founder. He's already 70 years old, so that's maybe a minor point. But he's a musician. He's the chairman of the board. Then the CEO is also a musician, which is important because they know the market. And what happened to Focusrite is during the COVID area, everybody started playing music. And everybody started buying gear. They also have a live music branch. That dropped to zero, but the other part just boomed so hard that the numbers went up and everybody thought this will keep going up. Somebody just told me at the table that the share price dropped 59% from the corona highs. So the exaggeration then is now turned around. Live music has gotten better, but the excess stock that was there at all the retailers, together with a product development from third to fourth generation for their main product, made it that everything had to go out with a discount, so they were relatively bad numbers. Now the trading update said it were good numbers. Stock already is up 20-30%, so I think it's still very, very undervalued, micro cap in London. Others we follow are Keller, geographical groundworks, but special groundworks. If there's a big building that needs to be put, or bridges or something, they do the groundwork for it. It's a UK company, but 80% of the revenue is from UK. But because it's UK stock, it's cheap. And then there's also a US company listed in the UK, Somero Enterprises, that make concrete leveling machines. It's just laser-guided concrete leveling machines. And the machines are so good, there are only 4 competitors worldwide, 2 Chinese, 1 other American. Why? Because it's still a developing market. They have to make the market themselves. People don't know they need it. And why do they need it? Because the machines are more efficient. Less labor, less concrete that's used. So it's a win-win-win. It's a win for Samara if they sell the machines. It's a win for the contractors because it's faster and cheaper to use. And it's a win for the clients because if the floor is leveled right, there's less expenses for the trucks that have to move in and out. There's less. They don't go bad.
Wear and tear.
Yeah, wear and tear indeed. So that's why it's a win-win-win situation. Why is it dropped so much? Yeah, because the construction sector is bad at the moment. It just is bad. But they don't do private market that much. It's mostly warehouses and stuff. And then with all the reshoring President Trump wants to do, it might actually be a trigger. But everybody is very careful right now because they don't know what's going to happen. So all the orders get delayed. And because it's very expensive machines, $200,000-$300,000. Yeah, one machine more or less sold is a big difference. So that's also UK listed. So
it's an American company.
It's an American company.
Why the hell is it listed in UK?
Because the IAM market back then said we want to attract growth companies, and they wanted to grow very fast. Didn't work out, but yeah.
Interesting.
There's another one called 4Imprint. It's the best performing stock in the UK. Ulrich is the expert on it. It's also all US business.
Yeah.
It's fully listed in the UK. Very cheap for that reason.
Yeah, people don't understand it. If they would move to New York Stock Exchange, I think the stock price would almost double instantly.
2 years ago, there were some of those in Hong Kong. You could have bought Samsonite in Hong Kong. They
they
to the US.
They don't know, yeah.
Awesome.
There's a lot of US real estate listed funds in Singapore as well.
Yeah, I saw that. Yeah.
For the hedging, because of the sort of the new economic way of thinking, would you do that also as a private investor, only holding your own holdings, or is that also mainly to please your clients that you have a stable performance?
No, actually not, because when we started to move our fund, the idea was first let's create a second compartment. We have a fund that can hold many. We have an umbrella fund that can hold many funds, and we thought, well, I'll just do this, and we'll start a second fund with all the other managers, and see where that goes. But studying it along the way made me realize this is not the way to go. If my brother-in-law or my sister would come to me and say, well, where do I invest the extra money? I wouldn't say drop it in the European small caps, drop it in the other fund and balance out. So that's why I said, well, this is no use. Let's put it all together. And that's also how all my money is in there. So that's how I would do it myself as a private investor as well. Knowing that Enigma is just, you can buy it at Saxo Bank. So I'm not a fan of Saxo Bank, far from. I think they have the worst customer service ever, but...
No, that's the hero.
I was about to say
Yeah.
I've never been kind at the hero, so...
Saxo's a good sector.
Saxo picks up my phone. Interactive
Exactly,
Brokers
the hero doesn't do anything.
Does Interactive Brokers pick up the phone for you guys?
No.
Depends on the time.
Because Saxo, they do always pick up, at least in the
That's why you do it through Linux, the links, because they pick up the phone.
Okay.
And they go to the Interactive Pro.
Yeah.
So you expect increased outperformance because of the hedge? Increased market outperformance over the long term?
Over the long term, yeah.
Yeah.
We expect it to be a drag on performance in good years. And
Same thing.
yeah.
But
But
the math clearly shows it's
Yeah.
outperformance. I've done it a million ways and I don't get to underperformance ever. Yeah, I get to underperformance if we don't have drawdowns in the coming 20 years, but I'll take that back.
Then you're retired anyhow. If you have no drawdowns for 20 years, then...
I'll take that back, yeah, exactly.
my partner in the fund is also not from and doesn't have a finance background. He's an engineer. Also from telecom space, sold his company, and him and his partners in the company were our first investors, the first 8 months. And he's a geek for numbers, and he went the option route. He read about the Black Swan from Nicholas Taleb, and he went that route. We met someone in Cyprus who was specialized in that. They sent mails that I know something about options, but yeah, just got a headache when I read those. And it was actually the American guy that told us about the Belgian guy. So we didn't know Luc at all, but they were in the same WhatsApp group with Nicolas Telep and Spitznagel. So and he said, well, don't you know him? He's also a Belgian guy. That's how we landed at his fund. But doing all the calculations, seeing it once you see it, you can't
unsee it.
Yeah.
No, I got the same thing. Yeah.
And you know it will be a drag on performance, and you will see other people make more money in good times. But when it comes the crash, you will have money to spend that others have not, and then that difference will be enormous. I did the calculations before with just cash. If you have 20% or 25% cash in your portfolio and the stock market drops 50%, the other people need to get 100% rise in the stock market. We only need about 70% stock rise because of that 20% cash. With the option fund, that 20% becomes 30% in cash in the first base. But if the stock market's off 50%, that's at that time you almost have 50% or a bit more than 50% in cash of the lower valuation. So if you invest all of that in stock markets, go doubles from there on, because just to get to the same point, you leave everyone behind at that point. But that's
Give you a practical example on the hedges we sold in April. That's netted us 50% return in 2 months, because we could just buy. There's so much shipping companies which was ridiculous cheap, and they just went back up 50% in a couple of months. So it's just free income we can generate there.
To me, it's the choice between having the hedges or cash, because staying 100% invested at these market times, to me seems crazy. And I couldn't sleep well if I would have 100% in the stock market at this moment. I think it's the valuation. We just had at the Schiller PE of the US above 40. It's happened one time before, and it was during the .com. It went to 42 and then it crashed like hell. So is it going to happen? I'm sure. When? Yeah, a year. I think it will be long if it's still a year. I would be amazed if you see that Nvidia has. You saw probably if you're on Twitter, you saw the circle. OpenAI says it will invest $300 billion in Oracle. Oracle went up 30%. Nvidia went up 5-6% that day because everybody knows Oracle needs to buy the Nvidia chips. Everybody knows OpenAI can't pay for those $300 billion. They're still loss making. So, and they're
non-profit apparently somehow.
So if you see all the competition, I can't understand how they will make money. It's not always the best product that wins. Another anecdotal story from from my past. We also sold VCRs, and we had Betamax and you had VHS.
Yeah, exactly.
And Betamax was actually technologically superior product. But why did VHS come through? Because Betamax said we don't do porn. VHS did porn.
It was not only porn, it was also because the patents of the VHS, the bigger companies had the patents in the VHS
but
and not in Betamax.
But the porn was a few.
The porn was
a few
added
billion.
benefit. Was added benefit. Yeah.
So that's something from the past. But I don't see OpenAI making that much money. In the short term. So Nvidia had to invest $100 billion to get it around. When you see things like that, you just know it's a bubble, and they know themselves it's a bubble, and now it's just waiting for the event that will.
During the .com bubble, value was actually quite resilient. In a case like that, you don't really have to hedge, right? Because if your stocks remain
that will be even better if our portfolio doesn't drop. We still have an influx of cash.
Okay, fair.
It's a win-win. That would be perfect.
We'll be very happy if that happens.
To add one anecdote, the Economist said a couple of weeks ago they did one calculation, and Palantir is potentially the highest value company ever in history.
Okay.
Because they did a sales multiple, and there's never been a company ever that had this sales multiple. give you an idea about where we are in the cycle.
400 times or something
I
like
don't know, but check out the article a couple of weeks ago.
The big,
worth it.
the big difference now is that those big companies that have the spotlight do make a lot of money
And grow quick.
and grow
Yeah.
quick. But Nvidia can't keep growing at this pace.
No.
I did the calculation for an investor day at VFB a few months ago, and to justify this price, they have to keep growing at 58% a year. And the fastest growing company ever, which is Nvidia, doesn't grow at 58% a year. So,
We have one person who works at ASML. Do you have a different opinion?
I agree.
I think ASML is if you want to buy into the AI hype. I think
This
it's
is the
ASML.
value play currently in the growth AI.
Absolutely.
Yeah.
I realize that my question or remark, I don't know, I want to see if it has a bit of a negative connotation. Don't mean it like that, but both you and Jasper are talking about starting a fund. But Jasper, one of his first slides was Buffett giving his famous quote, "When I have less than $1 million," and he said, basically that is now 10 million, keeping inflation into account. I would do my value investing, which I did when I was young, and make 50% returns. Joel Greenblatt is another one who did famously 50% for 10 plus years.
Yep.
Why don't you just take your own private money, make that 50% and live happily ever after? Why start a fund? Why all the hassle?
I was never able to make 50%. I wrote a book in
But
2000.
why would you start a fund if you're not personally able to make that 50%? I'm just curious, not to put you down, but I'm
No.
just. Everybody thinks, and a lot of people know me, I'm a special situations guy, because I think, if these guys can make 50%, why shouldn't I? And so far so good, but why not focus on the small caps, the special shits, all that kind of stuff? Why more the macro level and all
We
the
don't
tail
do any-
hedging risk?
We don't do macro instead of the hedging. Indeed, could be considered macro, but the rest is all bottom up.
Same here. Yeah.
Every company we buy is bottom up. Every investor we invest in, they're all the same. They all do bottom up, and there are ones that do special situations. We have Gianluca, who is an active investor. The Blue Water story, he was involved with that from Solvay. There was a factory, and the water was very blue. Somewhere that had to be stopped. So we do have special situation investors, active investors, people seeing a company that could do a lot better and try to turn it around. Robert is now fighting Dynacor management. Dynacor is also an interesting story if you're into commodities. They are a gold melter, so they don't delve gold, they're not a miner, but they melt it. And why are they important? Because if it's melted at them, it gets a quality approval. And people it's Canada company, Peru-based melter, and it's a trusted company. So the Swiss, Belgian, Europeans, if it has a quality approval, they buy it. But if you see the company, it could earn so much more. And Robert is actually fighting the board and getting board seats, and so we do that too now with the others. But to do it yourself, that would mean getting on a plane almost every week.
I'm not specifically referring to being activist, but both Buffett and Greenblatt and others were able to work out a strategy with a relatively small capital. Greenblatt was not small; it was 100 million plus, but still be able to do 50% a year. Why is that not possible for most investors, including you both? I think. It's just out of curiosity, not talking you down or anything.
No.
Kind of way.
I wasn't able to. In 2019, I wrote a book, and the title of the book was "Double Your Money in 5 Years." So do you know how much my performance was?
40%.
So, yeah, indeed, 14 and a bit.
42.
Yeah.
4.
40.4.
40.4.
It was 13.8.
We finance the rule says 72 in finance.
72.
Yeah,
But
so
I guess his question is, what gave you the confidence
Yeah.
or arrogance to take on outside capital?
Yeah.
That's really your question.
Because
right?
that
Well,
14.
you phrase it much more
Yeah,
nicely than I do.
because
but
the
that's
14
basically the question.
and the reason is because that 14% was more than double other people did. That's the reason why I started. because in the same time period of 15 years, at that period, the Belgian stock exchange was still below its high point. The US market didn't explode yet. So that 14% was more than double than the index investors at that point.
You actually had 15 years of track record at that point?
2004 to 2019 until the book. If you want to know my average now after those terrible 3 years, I'm now at 11.
Okay.
So
And
I'm humbled by now.
in my case, the reason I want to start a fund because I find I get extra motivated by having outside capital and doing my own capital. It's just an extra motivator for me because
Why?
it's
I'm
somehow
more
it-
motivated by my own capital.
yeah, no, but I'm somehow I also had to
Responsibility.
the responsibility element motivates me more than I did in
More
that.
than your own money.
Yeah, and I experienced this when I did my real estate development because I had used a lot of outside capital, and I found out that I was actually way more that outside motivation, that responsibility forced me to I don't know, forced focus better kind of thing.
And also you'll discover if you have your own fund, is that your investors actually also help you through bad months. Like if you, I've been a day trader for a little over a year, and Sharp ratio was awesome, but the bad months felt so bad, and there was nobody to pick you up and tell you that you were still doing a good job and you should look at the long term. And actually, I've had investors and I'm pretty easily shaken. And there's actually investors who say, well, doesn't matter, it's gonna go all right. And then obviously they were right, and you get through the bad times. But if you're only managing your own fund and you're on your own, like I am, they've got partners, but they actually help you and have faith in you. And if you don't have an employer or an investor, you don't have that, and this actually guards you from getting off course.
Well, I think that's personal, but
Yeah,
for me it
that-
doesn't really
that's-
matter because
Yeah.
I'm just curious. I
No,
just
it's
want to
okay.
have the overall discussion because everybody, a lot
Focus-
of people
focus
keep
on
on
getting
the
funds,
the focus on Buffett's quote, and I'm just wondering why so many people want to start a fund when they are not able to make a 50% return on their private.
But you're not competing about 50% against 50%.
Sorry.
You're
Yeah.
competing against somebody putting it straight into ETFs and hoping that the market will continue as it is.
And
No, but he's from
ETFs.
personal perspective. He's
Yeah.
looking. Yeah, I get it.
I'm just wondering why you would start a fund if you're personally not able to make the 50% returns like in Greenblatt or in Buffett.
But
Why does
why would you go for? Why do you need 50% to start a fund?
I don't say you need 50% to start a fund. I'm just saying why would you start a fund if you can make 50% returns in your private money?
Yeah,
Think
then
that-
you
think
why would you switch from being able to invest and get 50% every year?
And
Yeah,
the
but
small-
okay, but
to
you-
move them on.
Yeah, like
And don't go to the hassle of the whole.
Yeah.
Yeah, but you invest your own money in straight into your fund, so you make that same profit, and on top of that you get the 1% or and 20% performance fee or whatever fee you have in mind.
Zero.
I guess so it adds up.
Yeah, but it
And 25,
doesn't,
yeah.
for me, it doesn't
The
really
zero
matter
is-
about the fee. It's just
Yeah,
about.
But if you have 20 million under management,
Yeah.
it matters. That's like 200k a year.
Who cares? If you're making if you're making
Helmet, I
50%
love
of your own.
But you're not.
returns-
Nobody's. Like there's 5 people who got lucky enough to tell that story, and
That's
then
also
they
Lucky enough, it's nothing to do
and
with
then
luck.
they underperformed. Buffett has underperformed for 20 years
Yeah,
now.
because he has 600 billion.
Yeah, the investor cost and the cost.
The quote is,
But
what happened
he's saying that he can make 50% all 1 billion, but you don't know.
You can do it. You have to first 10 years of
No,
when
I
he was
think-
18.
Yeah,
and
this
then
is
he
a great
was-
discussion
to have over a beer.
Exactly.
There's a thousand
We'll take it,
Warren Buffetts who would like to say the same story.